All right, welcome guys. Happy Monday evening. It's my first time coming to you guys live in the evening, 6 o'clock Central Standard Time. This is the new time every single week on Monday that I'll be coming live and sharing some real estate training, advice, and tips with you guys. Today we're going to be talking all about real estate tax deductions. I'm going to give you 21 real estate tax deductions that I've picked up over the 11 years that I've been in the real estate business. Some of these are more commonly known. Some of these may not be very apparent to a lot of people. There's also going to be a couple strategies that I'm going to share with you guys that I've learned, and I've basically structured my business this way, and it's helped save me a lot of money on taxes. Before I get started and get too deep into the actual useful information, what I'd like to say is I am not a CPA. I don't even plan to or try to play one here on YouTube or Facebook. And so anything that I say, is strictly just what I've learned, but you definitely should consult and advise with your CPA or attorney before taking any of this and making it become real on your taxes. So let this just be some advice, and feel free to talk to your CPA when you're filing this year, and or just talk with whoever it is that you do your taxes with. So anyways, that being said, I'm going to just go ahead and jump right into it, guys. Pull up my notes here. And I've kind of categorized these. I'm going to start with the big topics and try and talk a little bit about them, and then give you the specific actual ones that I write off in my business and how I write them off. And at the very end, make sure you stick to the end, because I do have, that's where one of the strategies, which, I probably get asked the most frequently from agents about setting up an LLC and an S corporation. And basically that's how I've set myself up. And I'm going to talk a little bit about that and why you may want to start looking into this, especially if you have been in the business for quite some time and are making a decent amount of income from real estate. So that being said, the first category that I want to start with is marketing. So we as agents, that's probably going to be one of our bigger expenses, is marketing. Just about everything we do marketing wise is a write-off. I'm going to list a few of them out. Now, keep in mind, even like going to lunches and meals and that type of thing with prospective clients or with fellow agents where you're talking business, it still is a write-off, but it is only at 50% of the value of those meals. And so it's not a full 100% write-off, but it's still worthwhile to make sure that you're tracking those expenses. One of the other things that I read or that I picked up on as well, regarding tracking and actually keeping records of your expenses. I know a lot of people still actually keep the paper receipts for everything, and the only thing they'll ever write off is if they've got the receipt for it. There are a lot of articles online where you can read up about what is considered accurate or up to speed kind of tracking for your expenses to be able to write them off. And I'll be honest, from what I read and from what I do not keep paper receipts anymore. My CPA said, hey, you don't need to keep those. I used to have a big folder of them. Each year I'd put them in there. But now, I just have a statement from my account as far as like my Chase credit card, my RBFCU bank accounts, all that type of stuff. I've got good records. And then, of course, I put that all into QuickBooks. And that's how I keep my records. Now, if there is something where maybe it's like a meal or something like that, and I need to show that, hey, this is how much was spent for not just myself, but who it was that I took there, I will keep certain receipts and just file those away. And then also for some cash transactions, anything under $75, I read on a cash transaction, you probably don't need to do any kind of a receipt for it, as long as you're not just doing a whole bunch of them, if it's just here and there. But if it's over $75, like if you're buying something cash from somebody else, maybe it's a $500 expense or a $1,000 expense, it is best to make some kind of a sales receipt, just print something out, get it signed about, what it is, how much you spent, and then have the person who you bought it from sign it. So that we have some record of those cash purchases. So, okay, moving on, I'm going to go back into marketing. I do want to talk about that as being one of the first ones and some of the different types of things you might be spending your money on. Just again, I'm going to have a whole list of these. If you're watching this live, you won't see it, but once you watch the recording, if you're watching the recording right now, there will be a link below that you can click on, and you're going to be taken to the actual blog post that goes with this video. And it's going to have all of these listed out as kind of a list, so you can make sure when you're going through your taxes, you haven't forgot something that might have been considered a tax deduction. All right. One of the first ones is going to be open house signs and listing yard signs. So, whenever you're going out and you're buying signs for your business, hopefully they're branded signs. We've talked about that in a past video, but spend the money, get some branded signs. But all of those are a tax deduction. Listing flyers, business cards, your website. If you actually build a website, if you pay somebody to build your website, to maintain your website, hosting for the domain and all that type of stuff, anything related to your website, that's all marketing expenses. So make sure that you track that stuff. Direct mail campaigns. So if you're sending out send out cards, like I've talked about in the past, if you have something through another provider where they send out monthly things, or if you're doing every door direct mail and you're sending out, things to entire neighborhoods, just make sure you're tracking all of that and you have the receipts for those. Advertisements on Google and social media. That's a pretty no-brainer one, but if you're running ads, all of that is deductible. Management costs for running the ads. So maybe you're paying a company to actually run those ads for you. Again, I mean, sometimes they charge 15% or 10% of whatever your spend is. That stuff would be included as well. The next category is going to be education and training. I think that, if you're a successful agent, of course, you're going to need to be reinvesting into yourself constantly. Make sure that, you keep, you're keeping up to speed with all the new trends and the technology and all that stuff. So, education is very much a tax deductible expense here. And so we're going to talk about training, and that's definitely one. If you go pay for training, maybe you go to a conference or anything like that, you're going to be able to deduct all of the expenses for training. Mandatory continuing education. If you've got like an Audible subscription, of course, if you're using it for educational purposes and you're downloading educational books, that Audible subscription can be deducted. Any books that you're purchasing for the purposes of education, so real estate books, business books, things like that, online courses, and any coaching that you might be receiving are all tax deductions. So the next one we're going to move over to is licenses and dues. So we all know that there's a price to pay as a real estate agent. You got to constantly be keeping up with your dues every year, every quarter, every month for some of them, and so all of that stuff is a write-off. We've got MLS dues. You might have NAR dues, National Association of Realtor. You might have your association, so your local board dues. Brokerage dues, brokerage fees, any kind of desk fees, royalty or franchise fees. And then, of course, like if you're parts of special committees, like maybe here in San Antonio or wherever you're at, the Chamber of Commerce or those types of associations that you might be a part of, make sure that any kind of membership costs, you are saving that stuff as well. All right, moving down to services and fees. So this is another big one. So, you're going to, sometimes these are harder to track because they might not be huge expenses, but they do add up. Trust me, I look at my books all the time, and service and fees do add up. You've got bank fees. So if you've got any kind of, overdraft fee or any kind of just, membership fee to be a part of a bank or a credit card or anything like that, keep track of those. Bookkeeping fees. So maybe you pay a bookkeeper every month to manage your books. If you're doing them yourself, if you're using QuickBooks, of course, all of that is tax deduction as well. Business licenses. So like, for instance, maybe you have your own LLC, or maybe you have some other form of a business and you got to keep a license for it. Of course, that would be tax deductible as well. Interest on business purchases. So maybe you buy things on credit, maybe you've got a line of credit out or some kind of a loan out, and you pay interest on that loan. All of the interest is also deductible. Legal fees. So maybe you need some representation, you need a document drawn or anything like that, or maybe it's even for a client and you have to get an attorney involved and you're willing to pay for it or something like that, and you've got a legal fee that you have paid for. Again, tax deductible. Tax preparation fees. So whenever you go and spend money on getting a CPA at the end of the year, that is also tax deductible. Now, I will say regarding CPAs, this is something that I'm putting in the article. I think it's very important. Is if you're not already working with a great CPA, I highly recommend you look into it. I've been in the business for 11 years. I've used the same CPA. I used the same CPA for about 5 years. And then about 4 years ago, I made the switch to a different one. And so for 2 years, my first 2 years, I didn't have a CPA. I was just doing it myself. And I tell you, I saved so much money, even though I spent more on the CPA after those 2 years. I saved so much more money because he got me a lot more deductions than I would have never known. And the other good thing about a CPA, and this is what I recommend you do when you're going out and looking and kind of interviewing maybe a couple CPAs or talking to other realtors about CPAs, is ask them, are they just filing your taxes for you, or are they going to strategize with you and plan ahead of time? So for instance, like I will go meet with my CPA in January and talk to him about 2020, about what I'm going to be doing throughout 2020. So that way I set up my taxes as best as possible for when tax time comes around in April of 2021. Because if you wait to get advice until the year's over to try and save money, you've already kind of lost the game there. You've got to be strategic. You've got to know kind of the ins and the outs of what you can do, what you can't do. Should you buy a vehicle? Should you lease a vehicle? All these are things that you want to be planning for. And when you work with a good CPA, they should be a partner of yours in this business. You should not just be meeting with them in April to file your taxes. You should be meeting with them every quarter throughout the year and talking about the things that have come up in your business in the previous 3 months. That's just my recommendation. And again, you're going to spend a little bit more money to do that and to have somebody that's willing to give you that type of advice, but it's completely worth it. I have saved tens of thousands of dollars hiring the CPA that I have. So paying him, $800 to $1,400 annually is well worth it. So, all right. Let's move on to the next one, which is insurance. You've got all sorts of different types of insurance that you may or may not have to pay for. Errors and emissions insurance is deductible. General business insurance. So maybe you have like a kind of an umbrella policy for your business. That would also be deductible. Private health insurance. So us as real estate agents, of course, we got to go out to the marketplace, get our own insurance, is a tax deduction. Auto insurance is also one. So, you're paying your car insurance. We use that for business. That is a tax deduction. Now, automobiles. So that brings us to this next one, which is a tricky one. This one has all sorts of questions. And again, everything that I'm telling you guys tonight is just really as advice. There might be things that you want to go and make sure and verify, and all this stuff flies with, just in general, but also, with your CPA that he verifies that this is possible for you. But with automobiles, there's basically two different ways you can look at it. You can either do the kind of per mile deduction where you're just getting a flat, price per mile that you drive. Or you can do the actual kind of method where you are looking at exactly how much you paid on maintenance and tires and gas and all this type of stuff. And you're adding it up, depreciation, and adding it up and seeing which one is going to be better, more beneficial for you. And so it's definitely something that, there's no right answer for any one particular person. But in general, what I've found is that if you are driving a vehicle that is not super expensive, right? Let's just put a number on it, say under $20,000 to $30,000, and you are driving a lot of miles, you are probably going to be better off to take the mileage deduction. If you are driving a very expensive vehicle and you're not driving a whole lot of miles per year, you're probably better off taking the actual deduction and actually adding up your costs. And so that's kind of your general rule of thumb. Wherever you stand on that spectrum, if you're kind of in the middle, like maybe it's a middle vehicle and you don't drive too many miles, then you might have to just kind of do the calculations and figure it out for yourself. I'll tell you guys, like I kind of did the math myself, and for me, it is better for me to do the actual method versus the kind of the per mileage method. In 2019, you do get 58 cents per mile. So, you got to basically go out there, take however many miles you drove, right? And times it by the percentage that you drove that vehicle for work. So if, let's say you've got two vehicles and you have one that you use only for work, well, then you would use that 100% of the time. And you would take, let's just say you drove 10,000 miles on it. you would have a $5,800 deduction straight away in just the mileage kind of methodology there. Let's say you have a business, or let's say you only have one vehicle and you use it 75% of the time for business and 25% of the time for personal use. Well, then you would take 10,000, multiply it by 75%, it'd be 7,500 miles, and multiply that by the 58 cents per mile to give you what your deduction would be. If you go the actual method, there's different types of ways that you can kind of calculate this. And again, it gets pretty complex. That's where you want to get with your CPA. But there's different ways that you can take the depreciation on the vehicle, which is a substantial amount and is what's going to potentially make it more advantageous to go this route if you're not driving a ton. So first off, they've got one method, which is the MACRS, which I don't know if that's an acronym, MACRS or what, but that's basically your standard kind of depreciation model. There is a chart or a table where you can go on irs.gov and pull up. If you just Google MACRS, you'll be able to see the table, and it's going to tell you based on when that vehicle went into service, and you're going to, how much you can depreciate that vehicle year by year, depending on how expensive you paid. It'll be like a percentage, right? You just multiply what you paid by what the table tells you, and it's going to give you how much you can depreciate it that first year. There's also another one that's the method called bonus depreciation, where you basically get to take a little bit more than up to $18,000 for that first year to kind of depreciate that vehicle quicker, faster in that first year. Whereas if you just take the normal straight away depreciation, the MACRS, the maximum is $10,000 that you can take in depreciation that first year. Now, again, that's the maximum. That's not saying you can, if you bought a $20,000 car, you can go depreciate it $10,000 the first year. You got to go look at the table, figure out, what the percentage is, and then multiply it. 10,000 is just the max. Whereas if you bought like a really expensive vehicle, you might want more than 10,000. You might need to go with that bonus depreciation method, get 18,000. Then there's also a Section 179 method where it kind of, again, it's the same thing as the bonus depreciation, but I think even a bit more. And specifically, if you bought like an SUV, something over 6,000 pounds, you're going to be able to depreciate even more right up front in that first year. Now, keep in mind, though, if you do that in the first year, the depreciation on the second and third and fourth and fifth year, potentially, of you owning that vehicle will be less because you took a higher deduction in that first year. But it could be something that you strategize with your CPA about if you've got a lot of income this year and you just need more and more deductions. So again, that's the actual method. If you use the actual method, some of the different types of things that you can look for to add up would be maintenance, gas, and or electricity, if you're using a Tesla vehicle like myself, parking, lease costs. So if you leased the vehicle, that could go into your automobile costs, car washes, interest on auto loans. So if you didn't lease it, if you purchased the vehicle, now again, it's not the entire payment though. So don't think that, if you go out there and get a loan on the vehicle, your payment is, $600 a month, that you can write off the whole $600. You can write off the interest on the auto loan. Tires, if you've got to buy new tires for the vehicle, any kind of title, licensing, registration on the vehicle, and then of course depreciation. So, if you add all of that up, and you've got to do the math on the depreciation side of it, and it adds up to be more than what you would get from the mileage deduction, then you may want to go that route. All right. Let's see. So moving on to the next one, we're going to talk a little bit about travel. And so, if you are going to a conference, or maybe you're going to go, maybe you just work in different states or something like that, and you've got airfare or whatever it might be, of course, your airfare, your lodging, and your meals while traveling would all be considered deduction. Same thing with the meals, though. Keep in mind 50%. All right. So, if you're driving, oh yeah, here's the other thing. Yeah, if you're driving, again, you're going to get the mileage deduction for when you drive. So that's part of that travel deduction if you want to go that route. All right. Meals, we talked about it. Now, again, with meals, you do need to make sure that you're discussing business with whatever the meal is that you're taking. If you're taking a client, a spouse, a coworker, you do have to talk business. It can't just be, writing off every single meal that you do. So that would be one thing, is just make sure, again, use your best judgment. But if IRS sees you writing off every single meal that you've ever done, it's going to be really hard in an audit to prove that that was legitimate, unless you had really good accurate records and you really did do that. All right, office rent and utilities. So this is where we're going to talk a little bit about kind of the office situation. You've got home offices, you've got offices that you can go to. And so, for instance, on office rent and utilities, let's just say that you have your own office, something that you provide for other agents, or maybe you're just going there for yourself, but it's outside of your home. Well, the IRS gives an advantage to real estate agents who spend a huge amount on office rents and other utilities as deductible business expenses. If you're renting office space, the IRS gives you an opportunity to deduct your utility bills. So again, you've got to get internet into that office, you've got to pay for electricity and for water and whatever else it is, maintenance on it. Anything that you're paying for to keep that office up and going is going to be most likely a tax deduction. Okay. Now, if you got your home office, maybe you work like I do, right? You got your home office and you've got space dedicated. That's the key word, is you got to have space dedicated for this office. You can't say that, well, every day I wake up, I go sit on my couch in my living room and I do work there. That's my home office. You got to have some space that's designated for your home office. You can take a percentage of some of the expenses that you may pay for your house off of your taxes. So for instance, if you've got internet, right? There's a percentage now, and again, it goes with 50% of the time I'm using the internet for my business, 50% of the time I'm using it, for personal, or my family's using it. Well, then, okay, that's understandable. If I try and say that 100% of that is for business, that's going to be a little hard to prove, right? Like that, they're assuming that we're never using our internet if we're not on business at our house. I doubt that's going to fly. So again, use your best judgment with that. But again, internet, if you got phone line or anything like that, insurance, mortgage interest, rent, property taxes, all that stuff, again, but it's a percentage that you can take off. Security system, repairs and maintenance, and utilities. So get with your CPA, figure out, if and when that's the right solution for you, is if you want to take the deduction on your home office, but definitely something that you should consider. All right, gifts. So here's the one thing to realize, that with gifts, there is a $25 deduction limit on gifts, meaning that if you send something to somebody and it was $50, well, you can deduct 25 of it. The IRS is not going to allow you to deduct more than $25 on a gift. Now, talk with your CPA and talk to them about the potential of, if you put your own marketing on it. That is one thing that I've heard, that if it's got, the handy team at eXp Realty, I can actually deduct more than that, because now it is a marketing expense, which does not have that $25 limit. So it could be kind of dual purpose, potentially a gift and potentially a marketing expense, right? So just something to consider there. All right. Now, as far as sales go, we've got, different things that you might have engaged in during the actual course of a transaction that maybe you need to be reimbursed for, or maybe you weren't reimbursed for it, and then it specifically is a tax deduction. So for instance, like if you picked up the tab on an appraisal fee, maybe you paid for an inspection for a client, closing attorneys, if you paid for anything with the escrow of the deal, any type of concessions that you gave up, of course would come off of your total income. Courier service, delivery fees, finder fees, referral fees, anything like that that you're paying out. Home repairs to sell a listed property. So let's say you listed the property for a client and you helped them do some of the repairs. That is a deduction. If you bought the home warranty, inspection fees, notary fees, open house expenses. So if you held an open house on their property, photo editing, actually getting the photos done, paying the photographer, video, whatever it is you did, staging fees, if you covered those. So all those types of things to help sell a property are also tax deductions as well. All right, so self-employed health insurance deduction. Again, tax preparation for realtors can be challenging because it not only includes business deductions, but it's also, part of your self-help, right? Like, this isn't just the business of real estate. I mean, these health insurance deductions are for you as the agent personally as well, and they are also classified as deductions. look further into it, but you should find for yourself, fortunately, it is deductible if you're a Schedule C filer and your real estate business had a net profit for the present year. Okay, so that's important to note that you did have a profit. And so basically just make sure if you're profitable, then you are able to potentially lower your taxable income by reducing it from whatever you paid in for your health insurance. Okay, so keep that in mind. You cannot use it to go negative and actually receive like a credit back or anything like that, but they will allow you to zero out or get to zero if that's where you're at, or just use it as a deduction to reduce your income for whatever it is that you paid for your health insurance. Keep in mind too, something just kind of note, 2019, we did remove the uninsured penalty for not having insurance under the Tax Cuts and Jobs Act. So you may have seen that, maybe you didn't see that, but in the past couple years, you've probably known that you needed to get health insurance, because if not, you were going to get penalized for it anyways. 2019 removed that. All right, so let's go into business equipment expenses. So we are, I don't know, maybe it's just me, but I feel like I'm always buying new equipment for my business and trying out different things and whatnot. Well, this is where you can get a lot of deductions as well. And make sure though that they are legitimate deductions. If you go buy a big screen TV for your house and you try and say, well, it was for my office, and again, that gets to be a slippery slope. I promise you, it is not worth it to fudge your taxes, right? Like, use your legitimate expenses as what it is, right? So that being said, there's all sorts of different ones that you can deduct. Calculators, cameras, lenses. God knows I've spent a lot of money on cameras and lenses, so that's a nice deduction that I get to use there. But smartphones, cell phones, whatever it is that you've got, those are deductions. Cleaning equipment, again, if you're cleaning your office and you need a vacuum cleaner and you're using that legitimately to clean your office, that would be equipment that you're using. Computer, right? We got to have a computer. Equipment repair, so maybe something goes bad and you need it repaired or whatever, your computer fixed, that will be a deduction. GPS, any kind of hard drives, thumb drives, iPads, tablets, laptop, lock boxes. Of course, we gotta get our lock boxes. And if you had to spend money on a locksmith or getting keys made, anything like that, maps, printers, scanners, anything like furniture to stage a house. If you went out and bought something to stage a house, flowers or whatever it might have been, tape measure for your business. I bought one of these like rolly ones to kind of go measure how big a lot is. Those things aren't cheap, right? You're going to spend 40, 50 bucks on some of them, if not more. Video camera, already kind of talked about that digital camera there. And then of course, office supplies. So that's stuff, of course, we pretty much know most of these, but I'll just kind of run through them so that way it might jot your memory on a couple of the things. But like paper, ink, folders, client refreshments. Maybe you bought some stuff for open houses, waters, whatever it is, cookies, that type of stuff. Copier fees. Maybe you have an actual copier at your office that you've got to pay somebody to come maintain and whatnot. That would be definitely deductible. Janitorial services, office furniture, bookshelves, chairs, desks, filing cabinets, office supplies, envelopes, folders, paper, pens, postage, stationery, toner. And then of course, if you're paying rent, that is a big deduction, right? If you're paying, I was paying $2,500 to $3,000 a month in rent. That's a big deduction right there, right? Online storage of your business files. So like cloud hosting type of stuff. And let's go down to the next one, which is software and business tools. So this would be like QuickBooks, your CRM system. If you're using any kind of voice internet phone, right? Like maybe you have Grasshopper or any of those types of things that you're using that's like a service. You definitely want to make sure that you're deducting those types of things. Virtual assistants and bookkeepers. So we already talked about bookkeepers earlier, people that will handle your books as a service for you. But maybe you've got virtual assistants that you're paying out of the Philippines or out of India, wherever it might be, right? Like you're using Upwork or My Outdesk or something like that. Make sure you're keeping all of that in a tidy area, because that can kind of add up. I'll be honest with you. And so that is a good one that you make sure you are writing off. Family wages. So again, maybe you pay your family some money. And again, this is one that talk to your CPA about, but this is a huge way to deduct some money on your taxes, is to hire your own family members. So if you've got a, mother, father, brother, sister, daughter, son, right? Like, look into the benefits of actually employing them, of what that would do for you, right? To have an employee. Now, again, a lot of this kind of involves if you have an LLC set up, which, I mean, you don't have to, but I'll kind of share with you here in a little bit why I think it would behoove most of you as real estate agents to have an LLC with an S Corp set up. But just keep in mind that if you do pay any kind of wages, that is deductible. Payroll and unemployment taxes. So, if you do have payroll, you're going to realize that you pay more than just the salary. If somebody's salary is $100,000 a year, you as the business owner, you're paying them $100,000, but you're actually paying more than $100,000. You're paying that plus the self-employment tax, which is on your end about 7.5%, a little over 7.5%, I believe. So you're paying actually $107,000, right, for that employee. So payroll, unemployment taxes, sales assistant, we already said virtual assistant. All right. Retirement plan contribution. So this is another big one. I'm sure a lot of you guys, if you came from the W-2 kind of line of work, maybe, being a real estate agent, this is your first go around into an independent contractor and having your own retirement plan. So a lot of this can be new to you, but there are some differences that you need to be aware of when it comes to being able to use these as deductions. So there is something called a SEP, self-employment pension IRA, right? You can do, which for the advantage of this type of an IRA is versus a traditional IRA or like a Roth IRA, is that you can actually you can put more into it, right? So again, you have to have a business, an LLC, sole proprietorship, or something like that, and you need to I think that the normal deduction for a traditional or Roth is like $6,000 or $7,000 if you are over the age of 50. But with the self-employment pension IRA, the SEP IRA, it's actually for 2019, the limit is $56,000 or 25% of your income, whichever is lesser. So if you're making $200,000, then 25% of that's 50,000. That is less than 56,000. So the maximum you'd be able to contribute to that SEP IRA is $50,000. Now that is a lot of money, right? So it gives you the ability to write off a lot of money and put it into a retirement vehicle. So definitely look into a SEP IRA. Traditional IRAs, this is where you don't necessarily need to be a business owner to do this, but there are some limits, right? Like there's income limits to them. So for a traditional IRA, the 2019 limit is if you are making under $122,000 individually or $193,000 as a married couple, you can contribute $6,000 under the age of 50 and $7,000 over the age of 50. Okay, so that's kind of the big difference there. If you're making above those amounts, above 122, above 193, it phases out, and then it eventually goes completely away where you can't even contribute to that type of a plan. And then you also got what's called a solo 401k, which is similar kind of as far as like the reason why you would want to do something like this. A solo 401k is that you can contribute more to that than a traditional IRA. There's for 2019, the limit is $19,000 or $25,000 if you're over the age of 50. Now there's Roth counterparts to a lot of these. So you might see instead of a traditional IRA, you might see a Roth IRA, or instead of a solo 401k, you might see a solo Roth 401k. The only difference to that is basically what that means is in the beginning, when you are putting money into that, so let's say you put $6,000 into the Roth IRA, you cannot deduct that $6,000 as a deduction from your income for that year. But at the tail end, when you go to actually pull money out from that Roth IRA, it is tax-free income at the very end when you pull it out. Whereas a traditional IRA, you save on the taxes right up front. Like let's just say you put $6,000 into it, lowers your taxable earnings $6,000 for the year. But when you go to actually take money from that traditional IRA at the very end, you're going to pay the taxes on it. And who knows what the tax rate will be. Might be what it is today, might be less than what it is today, it might be more than what it is today. You're kind of playing that guessing game. With the Roth IRA, you are essentially paying that money with taxable earnings, right? Like you're not saving on your taxes for that year, but you are locking in and making sure that when you take that money out at the very end, you are not going to get taxed on it at whatever that tax rate is at the end. So let's see, legal and professional services. Kind of talked about this. Your CPA, your attorney, any type of legal or professional services you might receive. One really cool one. So now we're going to get kind of into the strategy side of it, and just a couple extra things, that bonus tips you may or may not know. But if you are a real estate agent and you have rental property, this is a huge advantage for us as real estate agents versus just, say, the average person who goes out there and gets rental properties. So if you're a real estate professional, you are eligible to deduct losses on rental property that you own. If you are both a landlord or a lady and a realtor, this can make for a substantial deduction. A loss on a rental property is considered passive income for other professions and therefore can't be deducted from non-passive income, the type of income that you receive for your work. So basically saying that, like, if you are a dentist, right, and you're receiving non-passive income, like you've got a salary or something like that, and you also have some rental properties, you cannot take the losses from those rental properties against your salaried income. Whereas as a real estate agent, we can deduct any kind of losses from our rental properties against our income, which the great thing with rental properties is you probably are making money from them. You are receiving some income beyond what you're paying as far as the mortgage. But when you start looking at the write-offs and being able to depreciate that rental property, on paper, it may look like you are actually losing money from it. And so you're getting the benefits of actually really making money, but because of depreciation and things like that, you may be losing. And then when you lose that money as the property owner, you can actually write that off against your business income as a realtor. Huge, huge benefit there. So provided that you or your spouse spend more than half of your working hours throughout the year in at least one realty business, you're able to deduct realty property losses from your regular income. Now, again, the minimum hourly requirement to qualify for this deduction is 751 hours annually. So you got to be able to show that you were actually working or invested into that real estate business, your flip home or your rental property or whatever it is. You had to show that you spent over 751 hours annually to do that, right? All right. Additionally, you also need to materially participate in the management of the rental properties that you own. At least 500 hours worked at the rental activity would constitute material participation in the eyes of the IRS. However, there are other ways that you can qualify. If you own multiple properties, the IRS requires that you only material participate in 500 hours for all of them if you make an election with that IRS. So there's actually, you got to go online, you got to fill out a deal to for the IRS to be able to treat all of your rental properties as a single activity. If you don't do that, then you're going to have to do 500 hours for every single property. You're going to have to show that you spent 500 hours working on each property, which that would be impossible, right? So make sure if you've got 10 properties, you go file that election with the IRS or have your CPA file that election. Make sure it's with them. And that way, again, 500 hours for in total of all your properties. So like I've got 3 rental properties, pretty easy for me to show that, I spent 500 hours throughout the course of a year working on that, like figuring out stuff, maybe just whatever it takes, right? Like there's different ways that you can kind of keep a log of that. Maybe you have to go drive over to the property. Maybe you got to talk to your property manager for some stuff. Maybe you've got to meet the maintenance person over there. Maybe you're just out looking at other, at those rental properties to buy them early on, right? There's all sorts of ways that you can rack up those hours. All right, so now we're going to talk into the S Corp election status. So a lot of you may have already set up an LLC, but you don't have the S Corp election status. If that's the case, I'll tell you, you're missing a huge tax opportunity. Being an LLC is great. That allows you to limit your liability, right? As a general business owner, right? Like, you limit your liability individually when you have an LLC. But as an S Corp, truly what an S Corp does is it actually just takes that company, and it just changes kind of the taxing classification of it, right? It doesn't really change anything with liability or anything like that. It's really just for taxes. And essentially what it does is it removes the self-employment tax on any kind of dividends that the business pays to you. Now, stick with me because that might sound a little confusing. So when you are an S Corp, what you're going to end up doing is you will now have to pay yourself a salary. So this is fine for, if you are a individual LLC, like an individual owner LLC. All right, let's just say in real estate, you have to pay yourself a reasonable salary for what most people earn in the industry. So for real estate agents, paying yourself a salary of $40,000 could seem reasonable. Again, talk with your CPA, but if you look up online, even NAR talks about it, the average real estate agent's salary is around $40,000 annually. So if you paid yourself that as a salary, that would not, in my eyes, raise any red flags, right? So if you pay yourself the $40,000, but let's say the business made $100,000, right? You made $100,000 in sales after your deductions. Well, you will pay self-employment tax and of course income tax on the $40,000 that you've paid yourself as salary, but then on the $60,000, you will not have to pay the income tax, or the self-employment tax rather. And self-employment tax is about 15%, because as a self-employed person, you are paying both sides of that tax. And that's for like Social Security, Medicare, right? Like that's what the self-employment tax is basically covering. Typically, like if you are as an employee, right, you're going to have to pay some taxes out of your paycheck, but then your business, whoever is employing you, will pay the other half, right? Well, in a self-employed situation, the IRS knows that you are the business, so they take both of them from you. So you pay 15% taxes for that. Whereas again, if you have an S Corp, you will end up paying yourself a reasonable salary, let's say $40,000, and then the remainder of that is considered dividend income, and you do not actually pay self-employment tax on that. So if you're figuring in 15%, and you look at, and this is just super easy math, there's some intricacies and it'll change these numbers a little bit when you actually look at the real numbers. But if you look at $60,000 of that income that you're saving, and you're saving the 15% of that, that's almost, what's that, $9,000 right there? That is a lot of money that you can potentially save. So there's a couple things you need to factor in when you decide to go with an S Corp. First and foremost, you, in most states, need to be a licensed real estate broker to even get paid into an LLC, much less an LLC S Corp. So if you don't have your broker's license, then the first thing you would need to do is go get your broker's license. So that way, when you earn a commission, your broker will be able to pay you into your LLC versus paying you to your Social Security number. When you set up an LLC, you're going to get an EIN number. And most brokerages, you just go to your broker and say, hey, I would like to get paid into this LLC now. And if you are a broker, they should be allowed to do that. At least here in Texas, that's the state I'm in, that is how it works. And at my brokerage, that is how it works. I've already spoken to them. Again, go talk to your broker, make sure it's legal for your state. But if you open up an LLC and you are a broker, there is the ability for you to get paid into that LLC. And then when you do that, and you now file to have an S Corp election status when you create that LLC, then you can do exactly what I just talked about. But even before you go with the S Corp and setting all this stuff up, the other thing too is that you got to make sure that you're earning more than what a reasonable salary would be for a real estate agent. Otherwise, it doesn't really save you any money, right? Like if you're making $50,000, I don't know if it's worth all of the hassle to go out there and make an S Corp election, because let's just say the reasonable salary is $44,000. For the $6,000, it's not going to be worth it for the amount of work most likely to put into this. And so because there is going to be additional paperwork, I'm sure your CPA will probably charge you a little bit more to do these because they're a little bit more complex to do these S Corp filings. But again, I feel that it is worth it. All right, last couple things to note, and then we're going to jump off. Two important ones. If you are a LLC, if you've got contractors and you're paying them 1099 income, make sure to get those 1099s out to them before January 31st. So you only have a few days left. to get those filed and sent out to them. They got to be in no later than January 31st. And then lastly, if you are also a self-employed business owner, it would behoove you to start doing quarterly taxes. I realized this like 2 years after I started, I formed my LLC, and I had to pay a penalty. There's actually a penalty if you only pay it in April, right? Like there's actually estimated taxes that you need to pay throughout the year, and there's different dates. So January 15th being the first one. So we just passed that one. That would be your estimated taxes for, of course, the fourth quarter. And then April 15th, which would be your estimated taxes that you made in the first quarter of the year. June 17th for estimated quarter for the second quarter. And then September 16th. And so those are the 2020 dates. If you're watching this in 2021 or something like that, they might be slightly different, but I'm sure they're going to be around those same time frames. But just make sure that you're paying your quarterly taxes. And again, that's why I go meet with my CPA once a quarter, because we talk about that type of stuff. It's super simple to do. Now you can just go on the IRS's website and make those payments. So that way it does a couple things. First off, when you end the year, like, here coming up in April, I'm not worried that I'm going to owe $40,000 or something crazy like that I got to make all at one time. I will owe maybe a little bit more, or sometimes a little less, but usually not, because I've already made those estimated quarterly payments. So just keep that in mind as well. Well, guys, that kind of much that sums it all up. I hope that was helpful. Again, I'm going to state this one last time, not a CPA, just sharing with you what I know, my limited experience of taxes and being a real estate agent. These are just things that I've heard and talked to my CPA about and read and all that type of stuff. So definitely verify and make sure that before you take any of these types of deductions that you've verified these with your CPA. But hopefully this might have opened up the door of something that you didn't already know about, and maybe can use or at least talk to your CPA around this time around. But the most important thing, guys, again, I'm going to stress this, I can't stress it enough, that you go find somebody that you trust, that is your partner, that knows tax code. If you're making money, you need to make sure that you're keeping as much of that as possible. And so make sure that you're working with somebody that's willing to help you on a quarterly basis at the very minimum. And they're not going to charge you an arm and a leg for it, but that's just their business model. There's CPAs that are out there that truly all they do is file taxes. That's their business model. And then there's ones that do more strategy type of things, and that is their business model. Find that type, because it will save you money in the long run when you have somebody you can go to and run by them all of the stuff ahead of time before you get to the part where you're having to file your taxes. And again, one last thing, I highly recommend, if you haven't seen this already, go back and watch my QuickBooks video. I'll make sure to link it below. If you're not already keeping your own books, not only is keeping your books, something that makes tax time not as unbearable, but it is a huge help to getting all of the insight and guidance you need for your real estate business. When I do my, my books every single month, I do them twice a month. Whenever I do them, I can kind of see, is my business on track? Is it not on track? And, make adjustments as I go. Whereas, if you don't keep track of your books except for once a year because you got to file taxes, you are definitely doing yourself a disservice. It really is helpful to know where you stand, up to every single 2 weeks. You know what I mean? You go too much further than that, and you're just, potentially leaving a lot of money on the table, leaving a lot of opportunity on the table. And so again, I use QuickBooks. I've got a video that shows how I actually keep track of all that stuff. It's complicated in the beginning. It's not super easy if you're not like a numbers person or whatnot. But I promise you, if you stick with it, you do it month over month for, let's just say, the first 3 months, and you kind of begrudgingly go through it, and force yourself to get in there and learn things and watch videos and like figure it out, talk to your CPA, ask them some questions. Once you're done with those 3 months, I promise you will be much more versed at it. It will go a lot faster. And after, like I say, after a couple years or a year, like at this point, I literally log in every 2 weeks and maybe spend 10 to 15 minutes on it now. I've got rules set up so that way whenever expenses come in, they automatically are getting classified, categorized. There's only a few handful of transactions that might take place that weren't done before. So then I got to go in there and kind of manually code those, but it doesn't take very long, right? And then I set up a rule for it so that way the next time I don't have to worry about it. So all I can do is just log in every couple of weeks, and usually I'm looking at my profit and loss report. I can do all that type of stuff. And so I'll put my link below if you are interested in looking at QuickBooks, if you're interested in watching that video. But I hope this was super helpful, guys. I'm going to call it. I hope you guys like that new nightly format. I found that when I went into my analytics, the majority of my viewers that watch this content watch it in the evenings, right? Like 6 o'clock is kind of the average time, is when most of the people that I'm engaging with are online. And so I figured, why am I doing this at 9 in the morning? Let's go 6 o'clock at night, and when people are already on here and live, so that way we can kind of talk to them that way. And go from there. So again, guys, so happy that you watched this. If you made this all the way to the end, put it in the comments, put 1%. I love to see all those that made it all the way to the very end. And if you're watching this on YouTube, make sure to give it a like, hit that thumbs up button, put a comment. It helps me out. Or again, if this is the first time you're watching me, make sure to hit that subscribe button on YouTube, because you'll see whenever I go live and whenever I put out a new video, which is every single week. And guys, thanks so much. This is going to be a great year. I'm excited to bring more and more content like this to you. Give me about a day or so, and I will have the blog for this video out, so you can actually follow along, and I'll kind of list out everything in bullet point as far as if you missed something. But I hope everyone has a great week. I'll talk to you guys later. Bye-bye.